you saw tons of this value add bridge capital for the multifamily space going out the door to sponsors that were syndicators for the most part. That the underwriting was underwritten perfection.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larson. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, we have a fun and very informative episode with Jake Clopton, the founder of Clopton Capital. He works with real estate owners and operators nationwide on debt and equity solutions, and he's here today on our podcast to break down what's happening today in lending, rates, underwriting, where opportunities are opening up, even the insurance markets. We're going to dive into all these topics. Stay tuned. Jake, welcome to the show.
Thanks so much for having me on. Appreciate it.
Yeah, I'm excited to have you on today. You've got a ton of experience in all different types of commercial real estate, specifically on the lending side. And we've seen tons of changes here over the last few years. It's been a wild ride, on the investor side, on the operator side. So I'm excited to have that conversation with you. But before we do, Jake, I'd love for you to share a little bit about your background and how you started your business.
Yeah, absolutely. I started this company around like 2009-10 era. I was kind of transitioning. Before this, I traded interbank hedging product future, like 3-month LIBOR and Fed funds and all stuff.
Yeah.
Right. That was the crash, like 9 and 10. Right. And the idea was to start an intermediary that helps people find capital, because at that time it was really, really difficult to find capital. And it was actually a great time to enter the business, right? Whenever there's like blood on the streets and, there's the incumbent players are kind of leaving and people are much more willing to like talk to new people. That's kind of when I got started. I'm 42 now. So that was, I was the early 20s when we started that. Just started the business on cold calling. I think I sat there for 2 straight years, dialing, 100 different people a day, both capitalists and borrowers. Yeah. Today, we are really much more of a commercial real estate services firm than just financing. Our verticals are finance, insurance, buy-side representation brokerage, 1031 qualified intermediary, and commercial solar. I still run a finance side, but there's, several other people here that, operate each of the different verticals. A lot of these just work hand in hand, but it's all the same people, right? That, living with on each side. So that's us, man.
Yeah. No, thank you for clarifying that, because you do way more than lending and financing.
Quite a bit. Yeah. Absolutely.
I appreciate that. But you mentioned 2 really important things. One, when you can start a business during a downturn and survive in that is when the true power. You look at Facebook came out of the downturn. You look at Amazon really started to thrive. Tesla, Elon hung on by the skin of his teeth. Maybe you could lean into that a little bit, especially for some of our younger listeners. They're out there. They're in maybe a tough job market. You got AI disrupting a lot of the white collar jobs. You just beat the streets and went to old fashioned cold calling, which we found it still works. In this area.
I think cold calling, there's no better ROI. I think people are more nervous in cold calls than they are to of death. Sometimes I feel like I've employed a couple of people, man, that some people don't care. Other guy, I remember one in particular. He would do one phone call, and then he had to take a smoke break and walk around the block and come back. He was nervous, right? There
acquired
really is,
taste.
Yeah, I think it's one of those things where it's like the more people that are unwilling or hesitant to do it, the better return there is, right?
Absolutely.
And especially in today's world, I feel like fewer and fewer people are actually doing cold calls.
Yeah.
Or they're hiring people in like Philippines or something to do phone calls. So if you're a guy that's sitting here in Chicago or North Carolina or wherever, right? You're willing to do it yourself. I don't think there's any better ROI.
Yeah.
When there is a disruption, right? And there's difficulty and stuff like that. I mean, the things that I noticed is, people are versus times when you're at the top, like of the market cycle, or everything's very saturated. People are much more willing to like talk to new people, right? Because
Absolutely.
the incumbent people, like a lot of them are gone, or they're either no longer working, or let's say those lenders aren't putting out capital, stuff like that. So people are always looking for new things.
Yeah.
It might be a very difficult time to still close business,
Yeah.
but the relationship building there's no better time to do it.
Yeah.
So that's why, like, even though when we started, it still took a while to like close deals because it was still a challenging environment.
Yeah.
But the amount of, relationship building and base that I was able to build and then ride the way back up, that's where the real value came in.
Yeah.
I mean, just when things are as saturated as they can get and you're at the top of the market, you'll call around and everybody's going to say, well, I've got 3 guys that do this already,
Yeah.
and they've been doing it for me since the last downturn. So,
Right.
that
Yeah.
a lot of the answers, you get at the top of the market.
Yeah. No, that's a great point. And just to, just to underscore that, if you're listening and you're going through a challenging time, like that is where the foundation of your business and those relationships are built,
sure.
especially if you're going through adversity. So yeah, I appreciate you kind of expanding on that. And yeah, the cold calling, man, I'll tell you, I'll never forget starting this business. I used to sell knives. I sold med device equipment for, almost 2 decades.
Cutco knives?
Yeah. I sold Cutco knives. Yeah.
Yeah.
Absolutely.
Yeah.
And you realize, just it's a skill and you get used to it. And, just sales is a skill, and the rejection that you take from when people turn you down, you just say, okay, you do it and you do it again. It can, again, to your point, so many people, I just called myself today texting a friend, and I picked up the phone. I was like, sorry, dude, like I'm just so used to texting. It's so nice to have an actual conversation with people. So, yeah, if you're listening, pick up the phone, make those phone calls, hop on a Zoom call, connect with people, meet in person. It's a great time to have those connections. But Jake, like I said, we've seen a lot of, disruption in the commercial markets here. Maybe, for our audience that isn't as familiar with some of the changes, specifically on the capital and the financing side of commercial real estate specifically, talk about how the change in interest rates and kind of where we are, the new normal, so to speak, over the past few years, what that actually means on the capital side of the business.
Yeah, I mean, real estate is just a math problem. It's not even really a complicated math problem, honestly. Cost of capital is just one port of the equation. And, I can't even say it's higher. And it's been, rates have been up higher for a while now, right?
Yeah.
But they're at a more elevated position than were before.
Yeah.
And, I think the market has really digested where, the cost of capital is.
Yeah.
I don't, there obviously transaction volumes are still kind of low, and there are refinancing happen, and I think the story of, the variable rate loans has been told and all this more than enough in commercial real estate.
Yeah.
I think the big thing in the market today is not as much where interest rates are right now.
Mm-hmm.
And, other factors of cost of capital, as much as where are they going and what's actually going to happen in the marketplace to these different asset classes because of just candidly very large macro things that are going on.
Yeah.
Right. I mean, you rarely have like a lot of times, like, commercial real estate is very like, sub-market, intense, right? What's going on in the local area.
Yeah.
But in my experience, you very rarely have like so many large macro things happening at the exact same time that are really causing so much uncertainty. I mean, you did during COVID, right? But again, we all knew COVID was going to be over.
Yeah, that's more of a black swan type event.
Yeah.
Versus a cyclical trend.
Right. But right now, I feel like, everybody's kind of wondering, or maybe there is something almost like AI. I don't know.
Yeah.
what AI is going to do, right? Because we've
Mhm.
already seen, I don't know, 65,000 white collar jobs lost in the past 6, 7 months because of AI.
Yeah,
That'll accelerate. And that's, your upper middle class white jobs. That's what a lot of this economy is built on. So it's like, what does that do? What does that do to office space? What does that do to class A housing? What does that, what I mean? It kind of ripples through the
absolutely.
whole economy.
Yeah,
It's something. It's going to do something, right?
yeah,
But we don't know. In interest rates and cost of capital, right? We're still not totally sure what's going to happen there also, right? Because, are we in stagflation? Are we in a recession? Are we in an inflationary environment? And,
right.
and we have a new Fed chair coming in where, the interest rate policy going forward is going to be exceptionally different than what it was before. He's very anti-Fed balance sheet, which is the opposite of QE, right?
Yep.
And
Just
he's
just
very
just just touch on that for a moment for the audience. So, if the Fed's going to unload some of what they have on their balance sheet,
right.
quantitative easing. If you don't mind just diving into that, I won't steal your thunder here.
Yeah, quantitative easing was, policy that basically manipulates the yield curve to bring longer term interest rates down, right? So everybody knows the Fed changes the Fed funds rate, right? So you look at the yield curve. The Fed funds rate is the short end of the curve. That's the 30-day interest rates. And then there's all different interest rates along it, right?
Yep.
And the way that they can't really manipulate long-term rates without going into the market and buying you know, vehicles like treasuries and mortgage bonds, stuff like that. The incoming Fed chair, basically says, the expansion of the Fed balance sheet, which is QE, is, one of the biggest mistakes in monetary, policy because it caused inflation and just the yield curve. So, but at the same time, he's very pro lower short term interest rates. I think everybody knows
Yeah.
nobody was getting that job without saying they're going to lower. So, the shape of the yield curve is going to change, going forward, and I would expect it to be much steeper, right? So,
Yeah.
think about it. You're taking a bid out of long-term interest rates, and you're putting pressure, downward pressure on, short-term. So, short-term stuff like construction bridge loans should come down, but I would be surprised if you saw a lot of people taking, long-term fixed rate stuff going forward because you might probably see more pressure on those.
Yeah.
So, but again, we don't know, right? I mean, the thing about interest rates, and I used to do this for a living, I can tell you what's going to happen today.
Right.
Something might come out tomorrow and completely change the entire script.
Yeah.
But we rarely get a fundamental Fed policy change like we're going to when he comes in. So,
Yeah. Yeah. Thank you for underscoring that. And yeah, to your prior point, there are so many different macro variables that are changing right now. I mean, you talked about the elimination of white collar jobs. We also have, on the lower end of, like the multifamily market, for instance, we have immigrants that are moving out of the country.
right.
So we have maybe a slight less pressure on demand on that part of the market. Do white collar employees, do they move to a different area? I'm really questioning what we're going to do with office space because if we're having elimination of white collar jobs and I don't know, what are your thoughts on the office market specifically, Jake, and what are you guys seeing there?
Well, again, it's one of those things where it's like asset class and sub market dependent, right? And so, great example
Yeah.
is here in Chicago. All
Yeah.
right, so you have like the CBD, like the Chicago Loop,
Hmm.
and that's one of your more depressed office areas in the country because you have
Yeah.
like a lot of really old office buildings. They're large. It's central business district, right?
Hmm.
There's several buildings there that are almost completely vacant.
Incredible.
The
Yeah.
only thing to do with them is convert them to multifamily if you can. A lot of
Right.
people think, hey, we'll just go and we'll convert this office building multifamily. Well, unless you have the right floor plates, it doesn't really work.
Yeah.
Also, these buildings, it is really expensive to convert
Very
them to
expensive. Yeah.
multifamily like that.
Can be
The
more.
only
Yeah. It can be
reason,
more expensive than building new.
exactly, yeah. The only reason a lot of them are able to happen is because there's basically, incentive funds from the city to revitalize buildings.
Yeah.
If you go like a mile down the road to like West Loop, Chicago, that's like one of the best office subdomains in the country, right?
Interesting. Yeah.
But all new build Class A stuff, right?
Right.
So, it's very, if you're in old office space, I don't know. I think
Yeah.
in like a central business type district, I think those are just really challenged assets.
Yeah.
And, they're alternatives going into an asset class that we are seeing like, demand pressure on,
Yeah.
right? Where, if you look all around the country, you're seeing that have, either plateaued or they're coming down. And so we're having these old office buildings, you're having to do very expensive reconversions into, an economy where, the rents that we're projecting are maybe lower a year from now. So
Yeah.
I don't know. It's very, very deal dependent, sector dependent. I can tell you that the vast majority of these big office towers are not going to work unless the cities just give them a ton of money.
Yeah. Yeah. And it's interesting to see, almost a flip flop between, your core urban office and the resurgence in the suburban side. We got the millennials forming households and going out and starting families. And we've seen the suburban kind of come back in a lot of ways with respect to that. So yeah, it'll be interesting to see
Sure.
how that all plays out. Almost like we've seen with the malls here over the last decade, trying to figure out what's going on with retail and those sorts of
Yeah.
things. I want to get your go ahead.
No, I was going to say that the interesting thing about that is a lot of these malls kind of figure themselves out, actually.
Yeah. Yeah.
There's still like certain enclosed malls that are just dead, right?
Yeah.
But and like just around here in Chicago, there's a couple of those smaller malls that are just they're dead. But then you have certain Class A ones that are just killing it,
Yeah.
right? They fit the experiential thing. They've got the right tenant bases in there, like, and so it's just like office, right? I mean, old properties that can't attract people are just going to stay vacant, and there's really nothing to do with them.
Yeah. Yeah. I got a friend, they convert old malls to self-storage. And
Yeah,
it's
yeah,
been a great business. Old Kmart, stuff like that. It's been great. I think there's an opportunity to utilize some of that space for like senior housing as we see a real need in that over the next
sure.
several years. Yeah, you see the old people walking around the malls. Hey, just put their homes there too, and then they can keep doing
I've
it.
been seeing them where they've almost become like it's just like a village of medical services, all in the
Yes.
enclosed
Yeah.
malls. You're right.
Yeah.
Yeah,
Yeah, the hospitals take them over, and yeah,
yeah.
so it's interesting. It's again, it's an interesting part of the formation and the degradation and the cycling of real estate that occurs in different times. I want to lean into the multifamily space, Jake, and I'd like you to talk about. You touched on it very briefly earlier in terms of these bridge loans, these floating rate loans, and talk about how that created some of the distress that we're seeing today in the multifamily market, and then also talk about what we're seeing now in terms of loan to values and how lenders are looking at the multifamily market and lending in that market today.
Sure. So, I mean, what happened with the variable rate loans, and what we're really talking about here is bridge loans, right?
Yeah.
They were super high leverage, non-recourse, variable rate deals that maybe had rate caps or something like that.
Yeah.
And we saw this a lot. It was like very, very low zero rate environment, and there was just tons of liquidity out there.
Hmm.
And these debt funds or CLO lenders just wanted, basically we needed paper. And you saw tons of this value add bridge capital for the multifamily space going out the door to sponsors that were syndicators for the most part. That the underwriting was basically underwritten perfection. What ended up happening is interest rates changed. They went up faster than they ever have in history. Right?
Yep.
So the underwriting on the cost of capital side did not work because there wasn't enough cushion built in.
Yeah.
Also, rents plateaued, and the underwriting that a lot of these deals did and relied on was market driven rent growth. So if rents didn't go up 3% or whatever year over year, they weren't going to work, even if rates stayed low.
Yeah.
So you also had revenue crunch on that side because they weren't hitting their rent expectations, and
inflation.
inflation, right?
Yeah.
So expense inflation,
Yeah.
right? That's another thing.
Huge. Yeah.
The other thing is the vast majority of these deals that I see that get stuck and go bad, there was a very typical sponsor profile that was syndicators.
Mhm.
Um, Meaning that somebody took over, so there was a GP, right? And they were running the property and they raised all their investment capital around the deal, which effectively means that they didn't have the money themselves. And when these loans started coming due, right? And you not only did you have cost of capital, pressure, but also had rents that you weren't hitting. Not that they weren't occupied, they were occupied, but they just weren't
Right.
hitting rents.
Yeah.
And expense sides have gone up. Insurance is a great example, right?
Yeah.
Insurance is probably double or triple what it was, underwritten
Yeah.
at. Yeah. We've run an insurance agency. We see it every day. So what happens is, it's half problem. The property can afford less debt. So somebody
Yeah.
somewhere has to keep this property. Somebody's going
Yeah.
to come in and pay out this debt.
Yeah,
If
so
you're a
just to
syndicator,
touch upon that, I think an important note is for those investors that aren't as familiar with how a commercial loan works versus a residential loan. Commercial loan is going to be sized on the ability of the net operating income of the property to pay the debt service.
that's
And
where
if that net operating income is squeezed from a lack of rent growth and squeezed from the expenses on the opposite side, so that amount goes down, the size of the debt's going to go down. And then you compound that with interest rates, and
it's
it's going
just
to
a
go
math
down
problem.
even more. It's like
Exactly.
you said, it's not a complex problem. It's not complex math, but it's bad math.
Right. I mean, the other thing about the big difference with residential commercial loans come due,
Yeah,
right?
yeah,
So that's the thing. So you have to re-underwrite, you have to redo the deal, especially these bridge loans.
yeah,
And so with syndicators, they're the biggest problem that I saw was out in the marketplace because you have really two options. It's you go back to your investor base and you raise more capital from them, or you go if you want to. This is if you want to keep the property, or you go
yeah,
out to somebody else and you raise more equity.
yeah.
You know, one way or another, your investors are getting a much lower return than they're planning on, right?
Yes, yeah,
Because returns did not work out that we're going to, and or so for themselves, or you have to go give away more equity to just basically save the property.
yeah,
You can sell it and basically hope to break even and or just kind of like lose everybody's money, which I saw too.
yeah,
The guys that just kind of I saw their I watched them see their way through this were really like vertically integrated guys that could refinance, put some more money into it, pay it down or whatever, right? Um, so that's and that scenario, I feel like really hit at the end of last year. I haven't seen like a lot of those have figured themselves out.
yeah,
There was definitely a blend and pretend, sort of deal over the past 12 months where they were trying to figure it out, right? So a lot of
yep,
debt funds were stuck in this paper. There are some still stuck in paper,
yeah,
but they've either those assets, a lot of those assets have either moved on, they've sold, they've refinanced, or the debt funds took them back. So I've seen a lot of that work itself out. Um, the what's going on now that I see is there's an enormous amount of 10-year paper that's coming due,
hmm.
which is not not bridge loan paper, right? It's a ton of refinances.
So when you say
Um,
10, just define that for the audience, tenured paper.
10-year fixed rate deals.
Oh, tenure.
Yeah.
I'm sorry. Yeah, I thought you said tenured. Okay, gotcha. Yeah.
Oh, no.
Yeah,
10
yeah.
year
So your agency debt, 7 year, 10 year loans that are
agency,
coming up there.
lots of CMBS, stuff
Yeah.
like that. That was originated in the 16, all this stuff.
Hmm. Yeah.
I'm not seeing as big of issues with that
Yeah.
type of stuff. But as opposed to what we used to see with a lot of refinances, just a lot less cash out than you used to see.
Yeah.
Right. A lot of it's just rate and term because it just can't, maybe the property's just affording what it, had the debt that it has on it, or something like
Yeah.
that. Yeah.
Yeah. And just to lean in that again, Jake. So, if rates were, you're seeing, say, 4% interest rates
Mhm.
on a, let's say, couple, class A multifamily deal. Now rates are in the sixes. So what does that look like in terms of loan sizing for these properties? Just take like I say, it's a $50 million property. 5 years ago, what were you seeing in terms of loan to value and loan sizing versus what you see today?
Um, what it's really coming down to is just lower LTVs, not because people aren't willing to do, high LTVs, but it's, the debt service just isn't there to get it higher. I mean, if you're talking about the difference between like 6 and 4%, I mean, it's right 200 basis points higher. It's
Yeah.
quite a big difference in
Yeah.
cost.
Yeah. Yeah. So instead of a 70% LTV, might be looking at 55. 60% LTV.
Yeah, it depends on what it
Residential
is, right?
property.
If it's
Yeah.
Class A, pretty low cap rate, probably somewhere in there, 60,
Yeah.
65.
Yeah.
Yeah. I would think it would be a challenge to find a deal in Class A multifamily that could really afford like a 75% loan to value deal.
Yeah, the numbers just don't pencil. And to your earlier point, you're bringing in more investor capital, returns, turn down, and they're just not appealing. It doesn't make
Yeah.
sense to buy
Yeah.
it.
And that's why we've seen like a lot of this like joint venture fund
Yep.
based equity space just really they want to look at deals, but they're not really executing on them, right?
Yeah.
There's other alternatives.
Yeah, absolutely. Because you have the insurance agency, I'd love to talk a little about insurance, and like you said, we've seen rates go up, 2x, sometimes even more. And talk about the differences regionally as well. I know in the residential markets, you have markets like California. You've seen some real perversions of the markets out there. What are you seeing in different geographies across the country? And are we starting to see insurance rates kind of settle down a little bit or settle in place?
Um, Not really, to be honest. They're still
Yeah.
going up quite a bit. I think people are still
Yeah.
having sticker shock.
Yeah.
Anywhere where there's wind, hail, flood risk,
Yeah.
those insurance rates, those are high. I
Yeah.
mean, they're area. I mean, I've seen a lot of guys even like, listen, I can't even afford this. I'm going to just self-insure. But I mean, I get it too, right? If you're an insurance carrier, how do you insure something for a total loss?
Right.
You know what I mean?
Yeah.
And we've seen that now. And there's several things that are factoring into insurance. Uh, you know, climate, environmental risk, and inflation for of construction costs.
Right.
Those two things, are think about it. You have more often, like higher frequency of loss,
Mm-hmm.
and it's more expensive to repair it.
Yeah.
So that's one part of insurance that people haven't really thought of. Like, hey, their cost to really do what you're asking them to do to transfer this risk has gone up significantly. They're having to do it more often. There's a third leg of this chair. The lawsuits are out of control.
Yeah.
People suing insurance companies.
Mm.
I mean, it's not as much the property related lawsuits. It's lawyers have really gone after liability claims.
Interesting.
And those are just the three huge costs that we see out there in the insurance agency,
Yeah.
or in the insurance market. The days of sitting or like auto renewing your insurance policy and be like, oh well, I've got these guys market rate. You really don't know that. You need to market this thing every year to every single market that's out there.
Yeah.
It's a very similar business model to the lending side.
Yeah.
The other thing is and something I see much more frequently now, the insurance side is in carriers coming in and out of the market constantly.
Yeah.
You know what I mean? Like I in really changing like what types of property they'll insure or where they're going to do it or stuff like that. So every time your policy comes up, you really need to go out there and redo this process because the market may be completely different than it was. I mean, we've seen some policies out there, and this is, and just so everybody knows, this is a very common strategy from insurance carriers and other brokers and stuff like that. They wait 4 days before your policy is about to renew, give you your renewal. It's going to be like 200-300% higher, but you're going to have no choice but to take it unless you weren't around and marketed it because you need insurance. So what are your options? And also there's a minimum, amount of, you got to pay it, right? And there's a minimum earn on it. So you're stuck. If you've got a policy coming up, I would give it 60 days before.
Great advice. Yeah. Great advice.
Figure out what it is, because I promise you that's going to happen.
Yeah.
It's happened every single time and it's on purpose. I'm not joking. It's on purpose. We see it constantly. Also, if you're with like a very large insurance carrier, you would think that wouldn't be, or a large insurance broker,
right?
You would think that wouldn't be the case. It's going to be the case times 10 there, because that's just their MO. We have been consistently
I
beating.
laugh. It's unfortunate laughter because I've seen it, but
Oh no,
yeah,
it's absolutely how it is.
that's why it's important to. I got a little visit from my office partner, my dog here.
Yeah.
So yeah, it's unfortunate, but that's if you understand where people's financial motivations are coming from, it makes sense if you're
Oh
on
yeah.
the
Well, you
broker
think you have
insurance end.
something like insurance,
Yeah,
highly regulated marketplace,
yeah,
all this stuff. You wouldn't think there would be the shenanigans. No, it's 10 times what there is in any other industry. I mean, it just, you got brokers out there that'll block markets just so other
mm,
people can't do it. And then they'll steer you to the more expensive, and
mm,
it's ridiculous.
yeah.
Um,
Buyer beware.
but
Get out there, understand what you're dealing with.
yeah,
Yeah,
get out there, market as much as you possibly can. The other thing is like, insurance. And if you, the other thing, like insurance is they have to they have to pass risk from risky areas onto non-risky areas, right? Think about like Obamacare, right? They had
yeah.
to raise insurance rates for all the healthy people
We
to pay
can't get into
for.
that, man. We'll be on
Yeah,
that.
no, right. But it's the
My
same
rates
thing.
went up double. It's crazy.
Right.
Yeah.
Yeah, it's
Poof.
the same thing. So
Yeah.
even if you're in a non-flood and high risk area,
Yeah.
your rates have gone up too because
Yeah.
they have to smooth that risk over the whole pool.
Yeah. That's a great point. I was having this conversation with somebody about after I have a couple of friends out where the California fires were, and I was looking at the numbers. I mean, insurance. I love insurance because it's just a numbers game, right? It's a risk of loss, and you have to make that up. We do a lot on the life insurance side, which is
Sure.
it's a less perverted model, but the chance of those homes burning down in that area are 1 in 20. So a 5% chance every year. So if you have a $5 million home, insurer has to, they have to charge 5% of that plus their administration on top of that,
That's the thing. How do
which
you
is,
insure against
yeah,
that?
yeah,
How do you make that affordable? How do
it,
you make it affordable to insure against a 1 in 20 total
yeah,
loss?
yeah. So in that example, average home price of $5 million in that area, the cost of your insurance is $20,000 to $25,000 a month.
It should be.
Yeah, it should.
If you're doing the
Yeah,
math, right?
yeah. But they didn't allow it. So to your point, it gets spread across the rest of the country to other people. So,
Or the carriers just leave that market.
and that's it was unfortunate. I say, man, it's like a death spiral out there. I don't know how they're going to rectify
Okay.
that. Well,
I don't know.
Jake, let's talk about something a little bit more optimistic as we wrap up here today. I'd love to hear, like, where do you think the big opportunities are out there in the real estate market today? And I'll let you take that wherever you want to go, from an investor side, from a services side, from a funding side.
Sure.
I'll let you kind of pick
I
and
mean,
choose.
I think there's just like any disruption, just like any
Yeah.
time there's uncertainty,
Yeah.
you know, it's good. There's tons of opportunity right now.
Yeah.
Because of everything that's going on, all the technology platforms and everything, like all those platforms, they reduce friction in the market, right?
Yeah.
They make everything easier to access. So I don't think the opportunities are found online. I don't think they're found, just searching around listings and stuff like that.
Yeah.
But I do think there are an enormous amount of opportunities, maybe not necessarily in just old strategies, like just finding some, apartment building, on LoopNet, and then, it's that's right. Where I think the real opportunities is finding stuff that's off market, pounding the pavement, doing it yourself, calling these
Yep.
people, right? Generating the leads for yourself offline, recapitalizing, equity stacks. I think that's
Yeah.
a huge opportunity.
Mhm.
Finding cap stacks that you've got investor, like right now, like I'm sure there are investor properties that want to get their money out because of other stuff that's going on in the world, right? Maybe you can
Absolutely.
buy equity in those deals for cheaper than you would have entered, right? I do think, anytime there's difficulty out there, you're going to find opportunity to get involved in properties at a lower basis than the guy coming out.
Yeah.
I think that's the real opportunity right now, in a lot of real estate deals. The other side is, if you can take advantage of local government incentives in some way, right?
Yeah.
Tax credits, new market tax, anything like that. I think
Absolutely.
I think that is one of the biggest opportunities that's out there. And that's where people make the most money, candidly. Follow the government money, follow incentives.
Yeah.
However you can, however you can apply this to the property, right? In Chicago, there's a ton of incentives where you go into a property, they'll pay for almost all of your mechanicals and energy efficient upgrades. Use Section 8, stuff like that. Figure out, all the government incentives you can. That's where I see the biggest opportunities.
Yeah. I think that's a great point. Two quick examples. We're looking at putting solar on our house, and the company comes to me and they say, "Hey, actually, like, you can do it out of pocket. This company will finance it for you. They'll take the government tax incentives, and you cut your electric bill in half, and you're going to get basically free solar panels and batteries, and you're going to be paying less for electricity every month." And I was surprised. I was like, wow, that's interesting. We bought several deals in the Houston market where the city of Houston comes in and says, hey, if you make a portion of your property affordable, maintaining, the affordability levels, we'll reduce your tax bill 50 to 100%. And that makes the numbers work really well in those properties. So solves two problems. Makes the city of Houston look good. They create affordable housing, makes the numbers work for investors, and we're getting some of these deals coming out from, like you said, operators whose bridge debt's coming due, and they've got to get rid of these product. So yeah, I love your point there.
I think the real opportunity going forward, the value add from 10 years ago was increased revenues.
Yep.
I think the value add going forward is operational efficiency.
Absolutely.
Going in, identifying, like everybody can say there's two sides of this equation, right?
Yeah.
Income expensive. I don't think the market forces are there to really push rents, to really drive returns. I think it's really getting in and figuring out where is this operation. I'm really approaching this property like it's a business. Where can I run this business better? How can I reduce expenses? How can I, reduce utility costs, all this stuff? That's where I think the real value add on the bottom line is going to come from for the next 5 years.
Great point. And AI, robotics, all those things can play on that theme as well. So,
of course,
I love that take. And Jake, thanks for helping us end on a positive note here.
Absolutely.
With all the uncertainty in the world, you've added a lot of insight for our listeners on how the money side of these things work. So, thank you so much for your time today.
Thank you so much. Likewise.
You know what, Jake, my apologies. Where's the best place for our audience to stay in touch with you? Or if you have somebody that is in need of financing, insurance, feel free to share any other opportunities where you work with individuals and companies.
Yeah, I mean, we're nationwide. We actually kind of brand national too. I am exceptionally easy to find. You can connect with us on LinkedIn. Our website, cloptoncapital.com. Again, if you just type us in Google, there's hundreds of results.
Yeah. Now you're out there. You're all over the place, Jake. I loved it. Again, thank you very much for your time today.
Likewise. Thanks, Chris. Appreciate it.
Hey, Chris here again. I hope you found this episode valuable. Now I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.